Hello and welcome to Investors Hangout, your weekly guide to making smarter investment decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, today's episode tackles a behavior that most investors slip into, and that is chasing past performance. Why do investors do that? Why do we tend to buy more of something that has recently done well? To discuss this and much more, we have with us our CEO, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Let's begin with the obvious question. Why does it happen? Why do investors keep chasing the recent winners?
Simply because people tend to expect that what is currently on, will continue for a while, if not forever. And generally, new investors might think that it will continue forever. These trends don't change on calendar year end. They are rooted in some basis. Something is doing well, a segment of the market, or a trend in the market, or a theme in the market, or a sector in the market. That normally does, and it does for a reason. Something has happened. There's a greater demand. There is something that is triggering that, or it was completely out of favor. It was down in the downs, and there is a reversion to mean. There is a new kind of demand which is getting created. So there could be a fundamental reason backing it. Mm-hmm. And then the natural thing follows, that greater earnings, more investors anticipating it, chasing it, and then it becomes a self-fulfilling thing that people are buying because price is going up, and because price is going up, people are buying more. Mm-hmm. And then it carries on for a while till one day people realize that, oh, this suddenly has turned out to be too good, it's paying too much price for this. Mm-hmm. Or something gets, punctures it. It's rooted in the nature of the market, cyclicality of the market, and sometimes randomness of the market. This is something, but it does not end on a calendar year end. It can continue for a while, but it does not continue forever. And reversion to mean is a very powerful thing. It may, and that is something which most investors, while they are investing and enjoying the ride, once you start enjoying the ride and you are actually having a phenomenal ride, you also, even if you have a reasonable feeling that this looks too good to be true, you still don't want to believe it.
Right. A case in point is small cap funds, which did exceptionally well in 23-24. What really changed in 2025?
Nothing. In fact, if you look at it, 2023 and 2024, it did exceptionally well. In fact, so much so that everybody thought that small caps are not risky. And it was backed by a very fundamental reason. For the first, what I can decode, because sitting at Value Research, we have far keen sense of what is going on. What was driving small cap rally was two things. One is that we had this small cap funds were getting a lot of money. And when you have too much money chasing a certain defined universe, and then small caps got defined very nicely. 5 years back, there was no such demarcation that these funds can invest. A flexi cap fund can invest in a small cap, or small caps were not very arithmetically defined. Mm-hmm. Now the definition of small cap is that all companies which are beyond 250 companies are small caps. Mm-hmm. And then any fund manager can buy anything. And so many small cap funds, because they did very well, they got more money, and they had to buy those stocks again. Mm-hmm. Despite the leeway that they can have X percentage non-small caps, despite that, the small cap allocation, and small cap is extremely vulnerable to too much money chasing them. Reason is that in small cap stocks, one, they are small cap, they're not large companies, and then in most of the good small caps, the promoters have about 50% of the holding. So in a smaller company, which has a smaller capitalization, only half of it is available in the market. And buying them is so difficult, and the impact price is so high that if somebody has to sell 5% of the company's stock, it will have an impact. So most of the transaction happens informally, or through the market officially, but in a manner where somebody goes and sources those stocks for the buyer. So, and because of which we saw the surge and more money coming into them, that sustained. This year, and the valuation has gone to a level where many of the companies, one is wondering that are they really worth it? Do they justify? Are they value for money? Are they too pricey? Are they can we justify these valuations? Once we have this concern, And you remember beginning of the year, one fund manager came and said that small cap is primed for a disaster, or it is going to disappoint investor, primarily because valuation concerns and still money coming in. But I would say that it has not turned out to be that bad a fiasco. After a year when small cap went up by 60%, which was followed by another year which went up by 50%, and then you have another year in which they are down 10%, it is not a disaster. I think people have to be a little careful about looking at the silver numbers in 2025. That you start investing in silver with the anticipation that this thing only goes up.
Yeah, that's what I was coming to. Investors treated silver like the new Bitcoin. What really happened there?
Silver, besides being a precious metal, has a very has found a new utility. New utility which will create a new segment of demand. Right. When you look at all these renewables and the kind of consumption or the demand, the surging demand for silver in the new applications, that is a creation of a new demand. Besides being a precious metal, it is also a utility thing. Gold is only precious metal. Second is that for silver, for the first time in India, we saw the financialization. Yeah. And not very long ago. So now you can buy gold, silver ETF. That's a whole new demand. Financialization creates its own demand. So it can carry on. Silver has one more interesting dimension, that gold is mined. You go and mine and you get gold. In case of silver, it happens, it's not that you go and mine silver. You actually mine zinc. And the byproduct of that is, it's like, you buy, you get the crude oil and different degree of distillates actually become kerosene oil or ATC or this or that, and the leftover actually is your coal tar, used in the bitumen. So in that sense, in this zinc byproduct is silver, and that cannot be stepped up on demand. You can't do it at will.
Okay.
So supply can't be created at will.
Yeah. So now many investors, they argue that I don't want to miss out. If something is doing well, why should I not, go and buy more of it? What would you say to that?
I would say try it, but in a limited way. Okay. Have 5%, have 10%, do it deliberately, do it intentionally, do it with an understanding. It is too good to ignore. Don't follow my advice. But don't go 100%, don't go 50%, don't go 25%. Make sure that you're doing 10% and enjoy the ride, so that when it gets punctured, you are not left in disarray.
So then what should investors do instead of chasing performance?
Have a plan and be anchored to a diversified portfolio. All these things which will keep tempting you, will keep attracting you, and don't resist. You decide that whether you want to have 5% or 10% or 20% even. I'll tell you why it works like that. One is that these are not losers. They can just go out of favor. Make sure that it has some value. You are not just buying something which has no basis. I'll be a little worried about crypto. But here, there is something to it. It's a company, it's a small company, it could be a SME company, it could be, there's a structure, there's a design, there's an asset. Then comes so who should have 5%? Who should have 10%? Who should have 20%? Your 5, 10, 20% should be entirely dependent on that money becomes half and you will not cry. And some people can cry, even with 2% allocation, that my 2% actually goes down in value. So you decide your allocation depending on that. If your 20% goes up and goes on to become 35%, you'll feel very happy. And if your 20% gets reduced by, 50% of it gets shaved off in 2 weeks' time, be ready for that, and you can withstand that. It's fine. That is a function of your scale. That is a function of what you're investing in. That is a function of your experience in the market and your ability to withstand it. Then, so I think, and also depends that whether you are in the accumulation phase or whether you're in the deaccumulation phase, or it is not accumulation, not deaccumulation. You are just looking at your assets and watching it grow. You are not putting into it, you are not taking out, or whatever you are taking out is a very insignificant part of it. I think everybody should have a small allocation, if at all you should have. if at all you should have, if it is a mainstream thing, you would like to make it mainstream thing, then make it part of your allocation so that you will remain there at all times to come. That way you will be able to benefit from the reversion of mean in all the asset classes. So that is how it works. Be disciplined, be anchored to a core with a diversified portfolio, be methodical about your incremental investment, and don't be erratic with your withdrawal.
To put all of this in context, can you give some examples of how category leadership has rotated over the years, over the last decade?
Oh, every few years it changes. 2017, small caps and mid caps were ruling. Or even, 2022, after 10 years of being a laggard, PSU made a roaring comeback. Or the value stocks, they made such a substantial, 23, 24, that was the golden era of small caps, because small caps add significant value to an investor wanting that exposure, because when you invest in small cap yourself, that is what those are the people for whom that SEBI comes out with that report that 92% of people lose money in derivatives or penny stocks or small. So, when individual investors invest directly into smaller companies, they buy the garbage. And this is where the mutual fund adds significant value by just eliminating the complete nonsense, something unworthy of buying. So that filter itself works, and that is why when you look at 5-year, 10-year, 20-year return of small caps, despite the poor 2025, they still stand out. So there are most of the time, and look at what has happened in 2025. Silver, large caps, they are making large cap has made a comeback after a long wait.
Right. So if you have to take away one thing, it's this. Outliers, they can be temporary, but discipline is permanent. Thank you, Dhirendra, for explaining it in great detail.
Thank you.
Thank you for watching Investors Hangout. We'll see you in the next episode.